A stranger offers you two deals. Deal 1, he borrows $100 from you and pays you back in 90 days, with interest. Deal 2, same stranger, same $100, but he keeps it for 10 years. Here's the part that breaks your brain. The 90-day deal pays you more. That makes no sense, right? Locking up your money for a decade is riskier. It should pay better. But when exactly this happens in the U.S. Treasury market, when a 10-year government IOU yields less than a 90-day one, it has foreshadowed every major downturn of the modern era. And here's the twist almost nobody talks about. The danger doesn't peak when the lines cross. It peaks when they snap apart again. Hold that thought. I'll come back to it. First, the basics, in plain English. A treasury is just an IOU from the government. You hand over $1,000 today, the government promises to pay you interest and hand your money back later. The yield is simply the annual return, expressed as a percent. Hypothetical example. You pay $1,000, it pays $40 a year. 40 divided by 1,000. That's 4%. That's the yield. Normally, longer IOUs pay more. Why? 3 reasons. Time. Inflation nibbles at distant payments, and the future is uncertain. A decade is a long time to commit. So a normal world looks like this, hypothetically. A 90-day bill pays about 2% annualized, and a 10-year note pays about 4%. The curve slopes up. Green means go. And by the way, annualized on a 90-day bill means you don't get the full 2%. You get roughly 1/4 of it. Quick math, $1,000 times 2% times 90 over 365, that's about $5. Yes, 5. That's the price of total safety for 3 months. Now, inversion. Same 2 lines, flipped. Hypothetically, the 90-day bill pays 4% annualized while the 10-year pays only 3%. Get paid less for more patience. Upside down. Why on earth does that happen? Because of how bonds move. Bond prices and yields move opposite like a seesaw. When lots of investors buy a bond, its price rises and its yield falls. So here's the story an inversion tells. Big money looks around and thinks, trouble is coming. The central bank will have to slash rates to rescue the economy. Bonds already issued at today's higher rates become prized. So investors pile into 10-year bonds, locking in today's yield before it disappears. All that buying pushes 10-year prices up and 10-year yields down. Meanwhile, short-term rates are still high because the central bank hasn't cut yet. Short line up, long line down, cross. But wait, why does an upside-down curve actually hurt the economy? 2 ways. First, the expectations part. The market is literally voting that rate cuts, and the pain that forces them are coming. Second, the banking part. Banks borrow short and lend long. Your deposits are short-term money. Mortgages and business loans are long-term money. That works when long rates sit above short rates. Run the hypothetical math. Say the bank's short-term funding costs 4%, and it lends at 3.4% for 10 years. On a $100,000 loan, the bank earns $3,400 a year and pays $4,000. That's a $600 a year loss per loan. When lending flips from profit to loss, banks stop lending. Businesses can't roll over their loans, hiring freezes, layoffs follow. That chain, from flipped lines to lost jobs, is why this signal matters. Now, the track record. Across the modern era, this inversion has shown up before every major downturn, and false alarms have been rare. That's the closest thing economics has to a blood test. But, and this is crucial, it's a signal, not a clock. The gap between the warning and the pain has varied a lot. Sometimes long enough that people called the signal broken, right up until it wasn't. And here's the cruel part. During those long waits, the headlines cheer. Stocks hit highs. Commentators declare the soft landing achieved. The signal gets mocked as outdated. That's exactly when the snapback gets interesting. Which brings me to the open loop. The snapback. Everyone watches the moment the lines cross. But watch what happens after. The curve uninverts, often sharply, when short-term yields plunge. And why would short-term yields plunge? Because the market now expects emergency rate cuts, which happen when the economy is visibly weakening. In other words, by the time the lines snap back toward normal, the reason they're snapping back is that the damage is underway. Historically, re-steepening after a deep inversion has lined up uncomfortably well with the danger peaking, not passing. The all clear feels close. It's usually the alarm bell ringing loudest, so here's your dashboard. 2 lines, 3 grades, evergreen rules, no hot takes required. Line 1, the short-term rate, think 90 days. Line 2, the 10-year, the gap between them, long minus short, is your gauge. Grade 1, green. The 10-year sits clearly above the short-term rate. Healthy spread. Economy pedaling forward. Nothing to do but keep investing consistently. Grade 2, yellow. The lines flatten, gap near zero, transition mode. This is when you tidy up. Top off the emergency fund, avoid stretching into new debt, keep the boring parts of your finances boring. Grade 3, red. Short-term pays more than 10-year. Inversion. The warning has historically flashed here. Yellow grade moves become urgent. Lock in flexibility. Delay big leveraged bets. Keep cash reserves real. And the flashing grade, deep red. Red. And then the lines snap back fast. That combination, inversion followed by rapid re-steepening, has historically marked the danger peak. Not the end of danger, the peak of it. One caveat before you tattoo this on your arm. This is a dashboard, not a crystal ball. It tells you conditions, not dates. Nobody times markets perfectly with 2 lines. And a smart investor uses grades to adjust risk, not to leap entirely in or out. Evergreen truth, the emergency fund, the diversification, the steady contributions, those outperform any single signal over a lifetime. So, quick recap. The 10-year should beat the 90-day because patience deserves payment. When it doesn't, the market is whispering that rate cuts, and the pain behind them, are coming. And when the lines snap back, that's not relief. That's the whisper becoming a shout. Watch the 2 lines. Grade the economy. Stay skeptical of headlines. And remember, the scariest chart in finance isn't the crash. It's the calm right before the snap. If this was helpful, there's more on the channel. And honestly, understanding signals like this one is exactly how millennials stop feeling like the economy happens to them and start reading it for themselves.